Hello, everyone. I'm Mike Bernick of Smart Money Trader here at Booker Publishing. Welcome to today's session. I thought what we would do today is talk a little bit about how to follow the smart money in order to improve your investment success rate. After all, here at Margaritaville Trading Central, my goal, as always, cheers by the way, is to help you become a more successful investor, as I like to say. Invest like Warren Buffett so you can live the lifestyle of Jimmy Buffett or whatever lifestyle you choose. It's up to you. We can help you get there though with some of the strategies that I've used over 3 decades or more in this business, and some of the tricks of the trade I've learned along the way. Now today, as I said, we're going to talk a little bit about some of the various measures of smart money or money flow. Actually, it used to be called on balance volume back in the day. So let's start with a brief tutorial then, and we can actually take a look at what the chart school folks have to say about this. So you can see on your screen right here, on balance volume this is by the way, stockcharts.com. It's a great resource for all you folks that maybe are just learning about technical analysis and about trading, or even if even if you're an experienced investor, just as a refresher course to kind of brush up on what's going on. This is just a great resource to use. It's www.stockcharts.com. And you see right here in the banner at the very top, you just click on Chart School and you can look up all kinds of different indicators. It's a great resource. So the concept of on-balance volume goes way back to Joe Granville, who developed this back in the 1960s. And basically, it's just a measure of price and volume combined. It combines those two very important elements, really, of any technical analysis. Those are really the two basic tools of the trade, right? What's price doing, going up and down, and what is volume doing? How many people are buying? How many people are selling? So on Chart School, they give you a little bit of intro, talk about Joe Granville and how he started it. They also show you the actual calculation, just in case you wanted to put together your own spreadsheet or do it by hand. But basically, it's a running total of the volume in relation to price over a period of time. A period's volume is considered positive with this measure when the close of the price is above the prior close. On the other hand, it's considered negative on balance volume whenever the close for a particular day, like today's close, for example, is below yesterday's close. So it's kind of black and white. It's either positive or negative. There's really no in between. And you can see some of they show a chart here on Chart School of Walmart, and you can see the running total here on the lower level. This is on balance volume, which indicates more money flowing in here. Obviously, Walmart stock is increasing a bit. So, that's really how this price volume or money flow analysis got its start. Another kind of luminary in the industry that I followed, read his books, is Mark Chaikin, who developed many years later the Chaikin money flow indicator. Now, this is a little bit different. Instead of being just a black and white measure, if the stock is up, then it's positive on balance volume. If the stock is down, it's negative, according to Joe Granville's on balance volume. But Chaikin makes it a little bit more complicated here. Of course, everything in technical analysis is building in complication. Sometimes simplicity is better. But Mark Chaikin came up with something called the money flow multiplier for each period, each daily period, weekly period, depending on the chart you're using. And what he was looking for is how far does the stock close differ from the high and the low for the period. And then he would multiply it by the money flow volume. Okay. So basically, whenever the stock closes sort of more in the upper half and the higher it closes in its daily range, the better. And that would be the positive money flow. And by the other extreme, if you had a big down day, like a lot of stocks had a big down day yesterday, for example, and you close at or near the lower part of the range, the trading range for the day, then that would give you negative money flow volume. And they show you here again on stockcharts.com how you do the calculation in case you wanted to do it. And what you're basically looking for when it comes to interpreting this is you're looking for the cumulative money flow or the Chaikin money flow to be increasing steadily as the stock price is. it would be a negative divergence. And you can see that here on this chart. Of this is research in motion, which isn't even around anymore as a stock. But you can see right here, the stock in November hit a high, pulled back a little bit. And you can see that the money flow, the Chaikin money flow pulled back. Now, research in motion turned around and made another new high at the end of November, early December. But look what happened to money flow, still falling. In fact, it turned negative in early December. So that's a negative divergence, warning you that you better have a tight stop on this particular stock. And sure enough, we did see a pretty significant decline along with the money flow, which then bottomed right at the end of December 2010, early January 2011, when the money flow started moving in the other direction, picking up again. So those are two, basic, I guess you could say, tools of the trade that have been around for a long time. And just about any chart service you want to use, even the free ones on the internet, like like this particular one that they have for Chart School on the stockcharts.com. Excellent charts, and it's free. You can subscribe to it and get more bells and whistles. But a lot of brokerage accounts, like my Fidelity account that I use for trading, TD Ameritrade, Thinkorswim platform has wonderful technical analysis capabilities where you can call up any of these indicators, whether it be on balance volume or Chaikin money flow. They're generally included with it. So, my own interpretation, I'll look at my charts here, is a little bit different. What I like to do when it comes to money flow is sort of over the years, I just developed my own system, if you will. This particular charting software package I use is called TC2000. It's been around for a long time. Very robust. It has, Chaikin money flow in it, and it has unbalanced volume, has all those great indicators. They also have the ability to create your own measures, if you will. You can actually, put the dialogue box right in there to figure out your own formulas, your own settings, if you will, that kind of can help you create your own technical indicators. And, over the years, I've been in the business since the late 1980s. Over the years, I've learned how to do a little bit of programming, probably not all that great, and come up with some of my own indicators. And what I use, I call it smart money flow. Now, it's basically a derivative of on balance volume and Chaikin money flow kind of combined. But what I do is look at the overall balance of buying or selling, buying power or selling pressure, that is, volume related to price over various periods of time, and try to sort of condense them all into this one indicator. So I thought today we would go through a couple of stocks, and I would show you a list of short stock candidates that have negative money flow, along with long stock candidates that, in spite of the selling we've seen over the past couple of weeks, there's some stocks out there, believe it or not, folks, that actually have some positive money flow as well. And so I'm going to show you those two. So over the next 20 minutes or so, we'll see if we can get through 20 potential trades in 20 minutes, and that'll be a good way to introduce you to how smart money flow works, the power of it, and how it can really help you in your own trading. So also, I wanted to just open the the Q&A dialogue box. If there are any questions any of you folks might have today, perhaps you have some of your own stocks that you'd like to take a look at. We could certainly do that. You could just throw out the ticker symbol. You can see the Q&A box, right on your Zoom video screen. You can just click and open it on the Q&A, and then, just ask any questions, fire away, type it right into the Q&A box, and I'll be able to see it on my screen. It'll pop right up here. So let's see, we'll go ahead and get started here. Let me make sure my window is open where I can actually see all the Q&A. And this is it. So anyway, fire away any particular stocks, symbols do you have in mind that you want to take a look at? Feel free to fire them my way, and we'll get to those after we go through some of the charts I've got right here. All right. Close that out. And let's get started first on the short side. We've seen obviously a lot of turbulence in the market over the past few weeks. The S&P 500 actually declined and broke below its 50-day moving average late last week, continued a little lower yesterday. It's down now about 7-8% from the highs that it made in early September. And the NASDAQ 100, the tech-heavy NASDAQ, which really has led the way up ever since this rally started at the coronavirus crash bottom in March. The NASDAQ has really gotten clocked. It lost over 13% of its value at the lows yesterday, bounced back a little bit into the close, but we're still down about 11 or 12% from its high. Okay, so with that in mind, there have been a lot of tumbling stocks, and it's been sort of a target-rich environment, I guess you would say, for negative money flow. And you can see that right here. I've got some other indicators on the chart, but we're going to focus today on smart money flow. This is just MACD. It shows you the price relation to the trend. And you can see we're taking a look at H&R Block. What I like to look for in a good trade setup is pretty simple. The first thing you look at is the trend of the stock. That's where you start. That's the transmission, if you will. I like to call it the transmission of your trading vehicle of your particular stock or ETF you're tracking. Is your stock that you're looking at in gear to the upside or in gear to the downside? And MACD, moving average convergence divergence, that stands for. It's again a pretty common technical indicator. MACD tells you sort of where the trend is. Are you in gear to the upside or are you in gear to the downside? And in this case, we're taking a look at H&R Block. You go all the way back to beginning of the year and the big drop you could see that it had here in February and March. Since then, it hasn't really done much. It bounced up into early June around $19, $20, and then very quickly slumped right back to the 14, 15 range that it's been in ever since then. And you can see by the MACD, the price trend has been, it shows that it's been down, then it comes up here and flattens out, but it's really not in gear to the upside. I'd say it's not in gear at all right now. And here in the middle panel, we have the smart money flow. And so you can see right here, we've got 3 straight bars, and this is a daily chart. So 3 straight days of increasing, pretty steady distribution. That is, smart money is flowing out of H&R Block. Now, it could be, well-heeled institutional investors. It could be hedge funds, mutual funds, you name it. We don't know exactly who's selling, but we know it's significant selling pressure, which we see right here in this indicator. In fact, let's zoom in on this so y'all at home can see it a little more clearly. We'll just reduce these other ones so that you can see that. There it is, the smart money flow right there. And you can see it's been pretty steady. You could change your chart from a daily to say an hourly chart. On this hourly chart, you can see that there was actually some positive money flow coming in at the very beginning of September. It looked like H&R Block was going to try to move up and break out of this $14, $15 trading range. But alas, it turned to heavy selling around the 9th, 10th of September, and it's been pretty consistently down ever since. In fact, on an hourly basis, the deepest, in the red readings of smart money outflows come just in the last few days. So, the downtrend in H&R Block is probably well-deserved, and that would be a stock. I don't know if I'd short it here because it's already pretty close to its 52-week low, but I certainly wouldn't be looking to bottom fish in this particular name. All right, let's move on to the next one that I have here on the list, and that's Campbell Soup. Now, this is a company that's obviously a defensive type stock, packaged foods. It's a consumer staple stock. And, usually these are the kind of companies that do pretty well. And, sure enough, we saw, the stock came down and crashed just along with everything else, really, into the lows. But then when we saw the coronavirus kick in, obviously a lot of people were sheltering at home. So what are they doing? They're ordering groceries, and a lot of it is soup, I guess, that they're buying. And sure enough, Campbell came right back. Got up to about the mid 50s and then kind of got stuck in a trading range, which it really has been in ever since. But starting the beginning of September, we saw a lot, you can see it right here, a lot of, again, negative smart money outflows in this name. And, sure enough, we saw the stock just collapse in price. It's leveled off here over the last, week or two. But again, yesterday with the highest, you can see right here, the highest negative money flow day we've seen. So there are still some institutions, some big, well-heeled investors that are unloading the stock, that are getting out of it. So wouldn't want to take a look at it. And it's interesting. Sometimes you see the smart money flow, either inflows buying or outflows selling, come in clusters in the same groups, the same types of stocks. So this is Campbell Soup, defensive food company. Here's Kraft Heinz, which is the same thing. Now, Kraft again had a steep crash, of course, into March, but then had a really big gain where it actually got to a new 52-week high here in July and August. Again, a defensive name, a food company, right? They make ketchup. I mean, how much more defensive can you be than ketchup and mustard? Everybody needs that, even during the coronavirus. But the stock started to slump again early in September, and just in the last couple of days, we've noticed these two bars right here of negative smart money flow, that is smart money selling on the daily chart. If you look at the hourly chart, you can see there's been even more. It really started around, again, the 9th, 10th of September. You can see right here, there's a cluster of it, kind of came back to neutral in here, a few negative bars, and then the bottom fell out again. And we see a lot of negative money flow coming in over the last few days. It's kind of gone to neutral again in just the last couple of hourly bars. Shows up here on the daily bar. So we might be seeing some stability here in Kraft Heinz stock. Interestingly, it's pulled back about 50% from its high. That is from the March low to the high we saw, here in August. It's pulled back a little less than 50%, maybe more like 33% or so, which is, typical in any kind of a rally. You see a bit of a retracement. So, Kraft could be a company you want to kind of keep on your watch list if you're into defensive type stocks. Although I would not consider buying it unless the money flow turned positive, which it did, back here in June, it was positive. If you go even further back, you can see these other periods late last year of positive money flow. And this usually does tend to lead to a little bit of a rally in the stock. You can see here it was generally in an uptrend right after this batch of smart money flow on the buying side in June. Right now, still negative to neutral. I'd keep an eye on it, but again, look for the smart money buying to return. And then here's another one, same group, food company, Kellogg. They make, Frosted Flakes. They make Rice Krispies. So what could be more defensive than that? And you can see, of course, the big decline. In March, every stock had it. And again, just like Kraft Heinz, Kellogg's made a huge recovery from 54, ran up to about 72, new 52-week high here in July, and then started to roll over. And you can see why. In early August, you saw this first big cluster of negative money flow. That is smart money selling right here. Then it went back to neutral again, and the stock kind of went sideways, tried to rally a little bit. And then you can see just in the past week, it's been hit with another bout of smart money selling. So there you have three companies in the same sector, the same defensive food type sector, that are all seeing outflows in terms of money outflows. So, you want to kind of stay away from those at this point. Other sectors, same thing. Technology stocks, as I said, they had a great run, and then they were really hit hard over the last couple of weeks. And we've seen, accompanying the sell-off, we've seen some pretty steep smart money selling in some of the biggest names. This is Amazon, which is probably the biggest name. Now, you talk about a stock that made a spectacular recovery. I mean, here's the slump in February and March. It barely looks like anything at all. Stock fell from $2,200 a share down to about $1,600 a share, which is a big decline, but it doesn't show like much of a decline here, because then it zoomed all the way up to a high of about $3,500 a share here in August. Very defensive company, people shopping online more than they are in retail stores. So it makes perfect sense why Amazon was a buy at the bottom. And you saw some smart money inflows here in February, then some outflows in March at the low, but then strong inflows again in April, which kind of kicked off the rally. Since then, the last couple of months has been kind of neutral until this big heavy selling in September. So folks, this is telling me, that Amazon is really under some heavy selling pressure right now by big, deep pocketed investors. This isn't mom and pops just selling the stock. It's the $3,000 stock. This is big institutions that are probably cashing in on these big gains that they had, over the last 6 months, and are repositioning their portfolios, maybe a little less in tech stock and more in some other types of companies. So We'll have to see what happens here. But right now, it looks to me like unless this smart money selling subsides, Amazon could go even lower from here. And we see this in other tech stocks. Here's Arista Networks, which is, again, a computer network technology company, networking company that had the slump in February and March. And then everybody realized, oh, everybody's going to need technology even more because we're doing what we're doing right now. We're on Zoom, we're working from home, we're working remotely more often. And instead of flying out to see customers or see clients, people are just hopping on Zoom. And of course, all that takes technology. So Arista, came roaring all the way back from a low of about 160. The stock just hit $260 a share right at the end of August, beginning of September, and then started slumping again. And this was telegraphed a little bit ahead of time because we saw here in May, a little smart money selling came in, but the stock held up, rebounded. Again, in the end of June, beginning of July, there was a bout of smart money selling. And sure enough, the stock slumped, but then recovered and came back. And we went back to neutral. Even had one day here in August, there was some smart money buying. That proved to be the top, though, because right after that, we saw just steady, consistent selling for several days in a row. Neutral for a couple days, back to selling for a few more days. And so, that told us the stock was probably coming down. It actually broke support here. It's heading lower, and there's still smart money selling coming into it. So, that's technology. Here's another one, Illumina. This has really got hit hard. Of course, there's a little bit of a fundamental story here that I'll get to in a minute. But again, Illumina is a healthcare diagnostic research company, the tech sector. Again, a big beneficiary really of COVID. The stock ran from $200 at the low to $400 at the August high, a double in Illumina. Then they announced they're buying out another company. Actually, rumors started to surface that they're going to buy out a company that makes another diagnostic product called Grail. It's a company that Illumina actually helped start years ago. It's a private company. They were thinking about going public. Instead, Illumina announced that it would buy Grail, the part of the company anyway that it doesn't already own. And it's a pretty big deal. I think the price tag is something like $8 billion, if memory serves. And so, that's why we saw the stock gap down here in August. Smart money was selling even after the shares appeared to stabilize. There's still plenty of smart money selling here in August. So that told me, we could go lower. And sure enough, with this latest market correction and the news came out that they are making this acquisition, I mean, the stock just plunged from $380 a share all the way down to $260. Now, this is a company I like. I've owned it before. I've invested in it, profited from it handsomely in the past. Very well-regarded company. But, as long as you see this persistent smart money selling, you got to be a little wary of that. Looking at it on an hourly basis, we could see, heavy smart money selling here. But just today, as a matter of fact, just this morning at the open, the stock really isn't going anywhere. It's basically flat today. It's actually down about $6 a share, 2.5% decline. But look at this. We have a green bar. Smart money is buying. Now, one hourly bar is not enough to trigger a buy signal. But if this persists and it carries over into the daily chart where we see some of the, the big deep pocketed investors starting to buy Illumina again, smart money flowing into the stock once again, this could be one to keep on your watch list. Because as I said, it's been pretty beaten down. Okay, so that's some of the shorts, if you will. If you think the market's got more of a correction to go, then you might want to take a look at some of those tickers we just discussed. Now let's look at the long side and see what's been working in spite of the selling. And one of them is Walmart, which has been in the headlines lately because it is going to be one of the investors buying out TikTok from the Chinese. Not really sure how that integrates with Walmart's retail and online presence, but we shall see. Anyway, Walmart had a great run, of course. Again, a sheltering from home type candidate. Walmart delivers just as much merchandise as Amazon, or fairly close to it. As a matter of fact, in recent months, I read a headline that Walmart's grocery delivery actually surpassed Amazon's online grocery delivery for the first time ever. They're actually beating Amazon at their own game, at least when it comes to delivering groceries. So the stocks had a good run from a low of about $100 a share during the coronavirus low. It got up to $150 recently. So, that's a great 50% run in the stock. And you can see, it bounced around after the coronavirus low. It popped back up, but then it popped back down again. It didn't really do much of anything. There's a little balance of power selling, and then it would come back to neutral. So that wasn't really consistent or persistent selling. But then here in early July, look at this. You had a big bar of smart money buying, inflows, money inflows, persisted for days and days and then weeks on end. And that's when Walmart broke out to the upside from this, base it was in around a 125 and went on a pretty good consistent run to the upside. The recent run here just in the last, part of August was really almost parabolic. And then sure enough, the smart money turned into sellers again, whether they thought Walmart was too high, whether they think buying part of TikTok is a bad decision, I don't know, but I don't need to know. All I need to do is trust my eyes and look at the smart money flows, and they are very positive right here. Right here turned positive at the end of August, September. Now the stock declined, partially I think because of that news about TikTok and just because the market in general has been coming in. But look at the smart money buying. I mean, this has been consistent, folks. Even on down days, heavy down days, with the stock losing ground, we've seen consistent buying coming into it. Let's look at an hourly chart, and you can see the same thing sort of in miniature here. There was some smart money selling, right here in early September, but that quickly turned to buying around the middle of the month, went neutral again, and now it's been buying here just in the last few days. So it looks to me like Walmart's making a little bit of a base here, getting ready to launch even higher in price. We'll have to wait and see, but I like the fact that we've got consistent smart money buying in a blue chip, Dow component name like this, even after a pretty steep correction from 150 down to 135 a share. So Walmart is on my list for a potential smart money trade. You could either buy the stock at 135 or, since that it's kind of an expensive proposition to invest, say $13,500 for just 100 shares of this particular stock, what I'd be looking to do is buy call options on Walmart, perhaps November, maybe December call options, playing a rebound back to, 140, 150 in this particular name. And, I said before that the smart money tends to come in bunches. It comes in batches. And here we see another rival retailer, Kohl's, which got hit a lot harder because they're not Walmart. They don't have as big of an online presence. You can see the stock really plunged in February and March, had some huge smart money inflows right at the bottom in April, which drove the stock much higher into June when the smart money inflows disappeared and it turned it into outflows. But that was a good run. I mean, the stock ran from about $12, $12 a share all the way up to $30 a share. So that was more than a double in Kohl's during this period of time, all led by this consistent smart money buying that started in April, continued all the way through the end of the month and through most of the month of May before it petered out. So that was your clue right here to take profits when you start seeing even the neutral money flow. When you know that the smart money is no longer buying, well, then you can suspect that it might turn into selling. And sure enough, right here is when it started turning to selling, early part of June. And sure enough, that was your signal to take profits after nearly doubling your money in Kohl's. Would have made a great options trade at that point in time. And then for a while here in terms of June, July, even into early August, it was just neutral. Nothing was really happening. The stock's bouncing around. It came down, up again, down again, up again. Wasn't really doing much of anything. And then we had a lot of smart money selling coming in August. And that's where we saw this gap down. The Kohl's proceeded to go lower, then it bounced back a little bit. And sure enough, the smart money selling dried up, went neutral, and now the buyers are coming in again. Now, folks, this is telling you something. The entire market is selling off pretty hard. As a matter of fact, if you want to look at some of the index tracking ETFs, like the SPY, the spider they call it, which tracks the S&P 500 index. When we take a look at the smart money selling persistent in the spider ETF, that tells me that a lot of people are unloading just stocks in general. And when you see these index tracking ETFs have negative money flow like that, that's remarkable. It doesn't happen as often in ETFs as it does in individual stocks. You look at the NASDAQ QQQ Trust. This is an ETF that tracks the NASDAQ 100 index, all those big tech stocks like Amazon. And you can see the same thing here in September, just, heavy selling, heavy smart money outflows. So when you see a market backdrop like that, and you look at a company like Kohl's or Walmart we looked at earlier, and you see the smart money is buying this in spite of the overall market falling around us, people are interested in Kohl's. People are interested in Walmart. So, that tells me something. It tells me that, these stocks need to make my watch list because, we could see a very quick pop back to the upside once this selling runs its course, in which case you're well positioned for a smart money options trade in a company like Kohl's that you can, really magnify your profit potential many times over. Okay, so that pretty much covers some of the stocks I had here. Don't really see any questions in terms of new tickers. I guess you guys don't have too many of your own stocks that you want to trade, because I don't see anything on a Q&A here. So I'm not sure what's happening there. But at any rate, that gives you a kind of a quick overview of what I use, the tool I use, Smart Money Flow, in my own service, which is Smart Money Trader. You can see right here, you can look up a lot more about how this service works. In Smart Money Trader, I actually recommend individual options positions on stocks that are experiencing plenty of smart money buying. If we see the positive green bars, smart money inflows, then we use call options to leverage our upside potential, earn triple-digit gains oftentimes. And if we see those red bars, persistent selling, then you can always switch to put options and actually profit on the downside with these stocks. So it's a great, all-weather strategy. And you can learn more just by going to our website. Just point your browser to robbooker.com/smart, and you can get a lot more information about my Smart Money Trader service. Okay, so that pretty much wraps it up for today's session. I hope you learned a bit about following the smart money so that you can invest more like Warren Buffett and therefore live the lifestyle of Jimmy Buffett. Thanks for joining me, and we'll see you again soon. Thanks, everyone.